This is why the Shanghai gold contract was so very important when it came out, because it's a fully physically settled contract. There is no settlement possible in currency. Now we're going to start building the infrastructure to handle all of these data centers and the power plants and the transmission lines and all of that stuff. That's going to lead to commodity price inflation. So, and then when you have that happen, invariably you have a reorganization of the economy from the people who are getting jobs in this area of the economy. Now they have to go get jobs in this area of the economy.
Okay, ladies and gentlemen, today we have Tom Luongo, and today we will discuss what's happening with the US economy. We will discuss commodities, precious metals, portfolio structure in the current environment, and many other very interesting topics. So, Tom, thank you so much for being here.
Thank you, Vladislav. I really appreciate the invite. Let's get to it.
Thank you very much, Tom. So we have a lot of going on with the US economy. What's your macro take on what's happening right now, and what are you paying attention to?
I'm at this point with the U.S. economy, all eyes are, as always, are on Donald Trump, and they have to be, because what Donald Trump is attempting to do is to, in very broad strokes, to remake the way the United States handles capital at a fundamental level. And I mean by this is, it's hard to see with all the moving parts. But when you take all the moving parts, the tariffs, the sovereign wealth fund, his attempts to, knock out like the drug cartels and the tackle immigration, the reforms, Doge, all of this stuff, and of course then his attacks on the Federal Reserve, it all solves to the same thing, which is that the old system of currency arbitrage as administered by global central banks, he's breaking that model by taking the United States, the most powerful central banks, the Federal Reserve, and taking them off that system. And this process, I think, began with the implementation of SOFR, secured overnight financing rate, back in 2017, 2018. And it has only accelerated from there over time. So Trump is now inheriting the work that was done behind the scenes, interestingly enough, by the Fed itself under Jerome Powell, and now is able to build the foundation for the next layer of the new American system, which is in many ways very similar to what Alexander Hamilton originally proposed. Not that I've ever was really a very huge fan of this in general, but for this moment in time, I think this is the right path for the United States to take, given the situation globally. And when we get into geopolitics and we get into the situation in Europe and everywhere else, you realize that this kind of quote unquote protectionism is a necessary step. And it reminds me a lot of what I've seen from other sovereigntist minded leaders around the world over the last 20, 30 years.
Mm-hmm. And in relation to the interest rates, we see Trump putting pressure on Powell because he wants to see them lower. What's your take on this whole situation?
Well, the situation with Powell is kind of complicated, right? Because with Donald Trump, there's what he says and there's what he does, right? And so far, he's said a lot of things, and then he's not really done very much. Like, he's not targeting Jerome Powell, but he is targeting the Federal Reserve, and he's going after members of they're using guys like Bill Pulte and Scott Bessent and others to go after members of the FOMC who were put in place to affect the final stages of I'm going to flat out say Obama's treasonous takeover of the Fed by a bunch of communists and monetary theorists. And all of those people are soon to be removed from the process and removed from the FOMC. It's setting the stage for Fed reform either later in his term or in the next administration. Fed reform is not a thing that happens overnight. He's not going to fire Powell tomorrow, but he does need or want lower interest rates. But again, it's like everything else. It all depends on when and how. What he's doing is setting the stage to explain to the average voter in America who has no idea what the Federal Reserve even does. So to go, look, the Fed's a problem. And we have this cartel of technocrats that sit up on, in the Mariner Eccles building, deciding the fate of the entire American economy. And fundamentally, that's what he's speaking to. And Jerome Powell has to be, being the head of the Fed, being the head of the FOMC, he has to be that pincushion. He has to be that antipode to Trump, even if what Powell is doing by holding interest rates where they are right now, and I think that policy is all going to change in about 2 weeks or about a week and a half, that, that he goes after Powell in order to set the narrative, because he's setting the hook over time. This is a very complicated thing that he has to, that he has to sell to the American people. So there's that. Powell, for his part, has, run the Fed this year, I think, exactly the way I would have run the Fed if I was skeptical of Trump. And I've been one of Powell's biggest defenders, because I think he's handled the last 4 years. I think he handled the years of the Biden administration, the Biden junta, as I like to put it, perfectly. He raised interest rates hard. On the minute he was reconfirmed for a second term, he raised interest rates hard. He forced the entire world into a lower leverage situation. He started draining the world of dollar liquidity, and forcing everybody to, get real with the value and the cost of dollars. No longer is the Fed. I mean, when the Fed is at the zero bound, you got to realize that it's no different than any other euro dollar issuing commercial bank. It's just a commercial bank issuing dollars at 0%. It's a euro dollar engine system. It's the hyper turbo euro dollar provider. At 5.25%, it's not. At 5.25%, everybody else is screaming. And so in the past, the Fed had always had to short circuit any tightening cycle based on, what was happening in the American economy, because the price of dollars internationally is being set by LIBOR and not SOFR. And so now that we have the secured overnight financing rate here in the United States, based on based on the repo transactions and money market transactions in the American banking system, because that is what's setting the price of dollars, we're sending that signal to the rest of the world, as opposed to the rest of the world sending the signal back to us. And so because of that, Powell, I think, understands this completely, and has used monetary policy and used interest rates, which ultimately is what the Fed chairman is in most control over. He used that perfectly to get rid of Biden, undermine any chance that Kamala Harris would have a halfway decent economy coming, and a halfway decent credit system coming into the election. He started cutting interest rates just before the election, because, credit was really starting to tighten up within the banking system. And so, in order to stop a crisis from occurring, he cut interest rates by 75 basis points, by 50 basis points right before the election. That actually paved the way for Trump to be reelected. Trump then uses that against Powell, because Trump is amoral and he doesn't care. And that's fine. I get it. That's just politics, man. So now we're at 4.5%. The rest of the world has already started cutting. The SNB, the Swiss National Bank's back to zero. The ECB is at 2.15%. The Bank of England has cut 3 times since the last time that Powell's cut. That's a major signal. And all the way around the world, everybody's long dated sovereign debt is all rising rapidly. They're pushing past, either all-time highs or 15 to 18-year highs, right? I mean, we've got 3.5% on the Japanese 30-year. You've got the 30-year UK gilt going to 5.7%. But you'll notice that the US 30-year is still sitting firmly below 5%. And honestly, in my mind, that's just everybody trying to maintain spreads between sovereign debts. And because of that, they have a stock of treasuries that they're going to, I'm going to turn that off. They have a stock of treasuries that they use to defend their currencies and to defend their bond spreads. That's what central banks do. That's how this system is supposed to work. So what you notice in the financial press, what you notice in the political press and in the commentariat, the financial commentariat, especially on FinTwit, what you see is every time there's a small sell-off in the U.S. Treasury market, it's like amplified to hell and gone. Well, that's nice, but go look at France's 30-year bond. Like, they were going to run out of money in 2 weeks. Macron's got a 15% approval rating. Trump's got a 60% approval rating or 55% approval rating, whatever it is. It doesn't matter. The number is significant, and it's not 30, right? Keir Starmer is they're getting ready to lynch him over in England, like over and over and over again. So it's always a distraction. Hey, let's talk about the United States. Let's not talk about anything else. So the truth is that they're going to sell into this to try and keep their rates from rising by keeping American interest rates down. By doing that, it sends market signals that the interest that it sends market signals to the actual players in the market that the world's not blowing up, and they want to maintain their spreads because of all the interest rate derivatives and swaps and everything else that everybody has. No one wants anything to blow up. Therefore, it's used, in order to keep all of that kind of in a tight little band. But at some point, something has to break, right? If you're going to rig interest rates and you're going to rig currency rates, well, then something else has to give. And that's something else that's giving right now is gold. So there you are. But they're printing money overseas, where our M2 is rising rapidly. But so what? Like it was falling for 3.5 years, and now it's rising again. The savings is going up, and remember, M2 is just M1 plus savings, so savings is going up. That makes sense under an economy like this when you've got the United States at a higher interest rate differential to everybody else. If you can get 4% in T-bills, like why wouldn't you save if you had extra money, right? And you're not going to take on capital risk, and your risk of losing your job as the economy reorganizes and everything else. So obviously M2 is going to go up. And it's just, I find all of the commentary at the Volatility, it drives me up the wall because it's always so one-dimensional in its analysis. It's like everything else, even especially in financial analysis. It's so obvious that there are people out there that's literally just talking their book. Remember, everybody's out there selling their investment newsletter. I'm one of them. I'm not copping to something that I'm not, right? Everybody's doing their thing. They're selling their perspective on the world. And then they pick and choose the data points that they want to present to you in order to make their case. And it doesn't matter if it's the guys the Chinese guys that work for the CCP pumping gold. It doesn't matter if it's Peter Schiff pumping gold. It doesn't matter if it's somebody else doing their thing. Everybody has an agenda at a certain level because they all have a thesis, and then they look for their data points that. And I'm sorry, but I'm enough of a scientist, having spent 25 years as a bench and research chemist, to know when people are begging their hypothesis, right? And my hypothesis has evolved over the years about how the economy works. You listen to me now and you listen to me 5 years ago, and you'll hear a completely different story out of my mouth. Why? Because the data doesn't fit anymore. So, as I just said, like if everybody's selling their thesis, my thesis is the world is constantly under flux. And that my thesis is that Trump is trying to remake the system that started with the formation of the Bank of England in 1694 and get rid of it all and extricate the United States from that. He's made this almost abundantly clear, almost explicitly clear, that he wants a different thing for the United States. That's my thesis. And then I go out and I try and find data, not just in the financial world, but in the geopolitical world, in the domestic politics world, and culture war, and everything else that supports that thesis. And I got a hell of a lot more data back in what I'm saying, and a track record that, that says I'm broadly correct about all of this stuff. I mean, if I was wrong, I'd be like, dude, I was wrong about that 6 months ago, and I'm right up. Like it's not about any of that. And I'm not trying to throw anybody under the bus. What I really want is everybody to level up and have a better conversation. That's what I want. I want a better discussion about these things. I want a more honest discussion about it. And I just don't see that on a regular basis. It's actually quite frustrating, but you do what you can.
Yeah. So I would like to talk a little bit about this dynamic between inflation and deflation. So if we look at the stock market, it's very high. It looks like a bubble, especially in AI. So that's deflationary in a way if that bursts. Also, if we look at all the debt, that's in theory also deflationary. On the other side, we have a monetary system that cannot live without more inflation, without money printing, because it's not backed up by anything tangible. So what would your view be on this dynamics, and which one do you believe could win at the end in the relatively near term?
It's a very good question. It's a very broad question. Yes, we're having deflation in certain areas of the economy. We're going to have inflation in other areas of the economy. the way we talk about stagflation has got a particular definition of of high price inflation and amidst high unemployment. Um, I'm not a huge fan of that. I think I'd rather define stagflation as credit asset deflation, credit based asset deflation, and commodity based asset inflation. That what you have is a reorganization of the economy when it gets out of whack, where you have where capital is concentrated in the financial sector, or that which is driven by the financial sector. So credit-based assets, housing, and the AI is absolutely, in that respect, at least as of right now, it is absolutely a credit-based thing, right? Now we're going to start building the infrastructure to handle all of these data centers and the power plants and the transmission lines and all of that stuff. That's going to lead to commodity price inflation. So, and then when you have that happen, invariably you have a reorganization of the economy from the people who are getting jobs in this area of the economy. Now they have to go get jobs in this area of the economy. And so we have to have, so prices on the one hand have to come down, and prices necessarily on the other hand have to go up. This is no different than what we saw post 2000, the financial crisis in 2008, when I remember Peter Schiff and Harry Dent doing, innumerable debates on places like Jim Popava's show and others. And I used to sit and listen to them in my laboratory while I was a student of all this stuff. And, one's arguing inflation, one's arguing deflation. I'm literally sitting there going, guys, I was screaming at my, into my laboratory, like exactly what I just described to you. You're going to have credit asset deflation, you're going to have commodity price inflation, and the two have to balance themselves out. And we've already had the mass inflation thanks to COVID, right? We've already had this mass inflation, which Powell has done a yeoman's work of trying to, arrest and get rid of as much as possible. Now we're going to have a white collar deflationary impulse in labor. I'm not worried about the blue collar guys in the AI revolution. I'm worried about the white collar guys. I'm worried about the guys at the middle managers and the in the HR departments making 150, 200 grand a year, and they're not necessary. I mean, as bad as AI customer service is, it's not that much. It's not that much worse than what I dealt with when there was another human and it was being piped over to a call center in India. Like, it's the same thing. It's just as opposed to a bad script being read by someone who doesn't speak English. I've got a computer that's not particularly good at speaking English. I don't know. Like, at least the translator has a better accent. At least has a mid-American accent that I can understand. Service is exactly the same. So, hey, okay, whatever. I'm gonna, it's not going to cost me as much. So I don't, it's like it's all nonsense. So I see that as the big driving force. And again, in that environment, when people are worried about the return of their money as opposed to the return on their money, that's what happens during a crisis. We have a sovereign bond crisis occurring, precipitating itself now in Europe. Europeans are finally admitting this because they've run out of money thanks to Jerome Powell's high interest rate policy. They've run out of money to extend and pretend. They can't buy any more U.S. debt after having gorged themselves on it. They've gorged themselves on $1.4 trillion across the Eurozone since September of 2021, when Powell really began tightening. He began tightening before he raised interest rates. And he did so through the building of the reverse repo facility. Now that's been drained into the money markets, which is out there. And I don't understand how people think that like this is a catastrophic event. It was never it was always, no, there's money to be made out in the world, and the money markets are paying better than Powell is. Therefore, the money goes out. It's not that tough. People are just chasing yield, folks. It's not, it's not that difficult. But whatever. Like I hear this stuff all day long, and it just drives me up a wall. It was never, it was, oh my God, they're building this big thing in 2020, 2021. Like, the reverse repo facility is getting huge. There's a credit crisis, and now it's been drained. Oh my God, there's a credit crisis. Like, it's like, are you going to light your hair on fire every time like the state changes? Like, or how about you actually do some analysis about what the state change actually means? But it's always the same answer over and over and over again. The United States is doomed. And that's your tell, right? That to me is the tell. That's when I just started calling, frankly, bullshit on all of this stuff. I just finally said, look, I'm over it. Like everybody talks about how the United States is going to fall. I'm like, how is the United States going to fall? We're the core economy. Doesn't make any sense. Yeah, well, some things will happen at the edges. The BRICS will move some of their trade into local currencies, which they should do. They're going to settle up their trade imbalances like everybody used to in gold. They're going to find out that this is just as hard a system to maintain dealing with the Chinese as it is to deal with the Americans or whomever is going to wind up being the reserve asset that their markets pick. Fine. This whole idea that um, it's a tragedy that the U.S. is going to lose its global reserve status. Like the only people screaming about that are the people who think that America is an empire. Like America's not an empire; it's still a colony of the old British Empire because the British still run the global financial system. By the way, in case anybody hasn't noticed, all roads financially lead to London, and eventually all the wars and all the drug trafficking and everything else all run through London. Oh, and by the way, Toronto, they're just as bad. Like that's the story, and the rest of it is all just propaganda. Like the United States has problems, and we absolutely have sins that we have to expiate. But this is the path that we expiate those sins. We get out of all of this nation building. We get out of all of this color revolution stuff. We get out of all of this CIA, MI6, bombing of brown people for imposing democracy on them or whatever the hell it is. We get out of that system. We go home, we fix our roads, we rebuild our ships, and and put up protection tariffs around our producers. That's not imperial activity. That's the exact opposite of imperial activity. And yet a lot of people haven't gotten the memo yet. And then when you look at that data set, right? And then you still see people shilling this idea of an American empire. Like, oh, okay, right. You just work for somebody. Got it. Like, I know I can just write you off now. And it's pathetic. I wish again, I wish it wasn't that way. So, but it is. And, that's what we have to like navigate more than anything else. So the inflation deflation thing is real. The United States has, to this point, for the last 3 or 4 years, started a deflationary credit cycle to bring the leverage of the entire dollar system down. If the rest of the world wants to lever that back up, they're going to do so on their dime. If the ECB or the Bundesbank or the Bank of England or the Hong Kong Monetary Authority or whomever wants to build that back up, they're going to do it on their dime, not ours. Their currencies are going to have to collapse. Their bond prices are going to have to collapse as they try to print money to offset whatever their other dollar denominations are. You can see dollar, not denominations, but the dollar liabilities are. You can tell the difference by who's on what side of this divide, who's cutting and who's raising, at least up until today. The United States needs to cut because we have tariffs in place now to offset currency exchange, and now we can cut interest rates for domestic credit purposes, but still enforce a higher cost of doing business in the dollar internationally and keep the money from flowing out, right? Japan is still our wingman. Just slowly but surely, Japan is not normalizing monetary policy. So Japan started the process while, so they were raising along with everybody raised along with the Fed in order to maintain interest rates. But the Bank of Japan getting off the zero bound and fundamentally changing monetary policy, it's a big deal. And they're doing it slowly and they're being very cautious about it. But it's a signal that they changed monetary policy after 30 years. The same way it's a signal that Jerome Powell scrapped the 2% inflation target. What does that mean? Everybody's interpreting that he's going to go to 3%. I'm like, no, he's going to target the labor market, like is what he's supposed to do versus the dual mandate. And they're going to attempt to grow their way out of this thing, which is exactly Powell doing that, along with Scott Bessent convincing Trump that it's time to grow our way out of this. build a sovereign wealth fund, build alternate sources of revenue, and then, retire the higher price debt, the higher income, the higher interest rate debt that's on the balance sheet, and just, live with the fact that we have $37 trillion in debt. Who cares? Because, the unfunded liabilities of Social Security, Medicare, all the fraud, everything else, that's going to go away. The budget gets balanced. And then we just, invite $20 trillion worth of capital into the country and recapitalize it that way. And all of a sudden now debt doesn't matter because your balance sheet is 75 trillion. You got $75 trillion worth of assets, $100 trillion worth of assets, and $37 trillion worth of debt. Who cares? Who cares? And that's the way, anybody who looks at you do a balance sheet analysis of a company, right? What ultimately do you care about more than anything else? It's not EBITDA. It's not that. Yeah, it's not. It's shareholder equity. The only thing that matters at the end of the day is how much money how much equity is there in the company versus the number of shares that are in existence. And if shareholder equity is going up, no matter how they play the game, whatever they do with their margins and this, that, and everything else, at the end of the day, as long as shareholder equity is going up, companies expanding. They may play financial games with, buying debt to put it on their balance sheet. But at the end of the day, what we care about is shareholder equity. Debt to equity ratio is all that really matters. And as long as that's less than, honestly, as long as that's less than a certain, level, depending on the company, you're good to go. As a country, debt to GDP ratio is not necessarily a good metric because that's debt versus cash flow. Because GDP is a proxy for taxes, right? Tax base. We got to get out of that model. Donald Trump wants to do away with the income tax, at least for everybody in the lower and middle classes. So how do you measure debt? Why does debt to GDP ratio matter? What matters is ultimately, if you fix the budget and you fix everything else, and all of that's going to be both inflationary and deflationary. I mean, again, getting back to the original question, all of this is a mix of when you're reorganizing, when you're going through a transition state from one system to another system. Well, that also means that you have to now use different data points to measure what's actually happening under the new system. And the old metrics don't work because the old metrics only supported the old model, which was issue debt and tax the people to pay for the interest on the debt in order to lend currency into existence. That model is going away in the United States. I need everybody to wrap their brains around this. Crypto's a part of this. It's all a part of it. You wrap your brain around that, and you realize that you can change the cash flow model to be a return on investment model. All of a sudden, a lot of things don't matter, and a lot of conversations seem facile.
Okay,
at least in my mind. So
let's move to the commodity sector. We are already seeing gold perform, and we partially mentioned why that could be. But what about other commodities like energy, copper? What's your macro outlook on these, and how do you expect them to perform in the current environment?
Like I said, there has to be a move away from pumping credit-based assets, and I would consider things like NVIDIA to be a credit-based asset. Basically, what you want, what Trump is trying to accomplish, and I think a lot of people are trying to accomplish now around him, is to try and hold those assets prices that wherever they are relatively stable, meaning housing. Let's try and hold housing prices as bad as they are and as high as they are. We can't have them collapse by 30% because that would bust all the banks. Let's try and hold them at their current levels as best we can, incentivize people, get wages up, and so that they can work and pay their mortgages and all the rest of it. And where that comes from is by pushing people into jobs that actually build wealth by building things, right? That means I'm along the resource. I mean, in general, I'm along resource selection. Copper, I think if you want to build out the AI data center thing, copper's got to double in price. because the infrastructure is not there to mine the amount of copper that is needed to do so. So copper is going to have to, we're going to have to get the price signal that copper is, more expensive than it actually is in order to fast track new copper mines around the world and get rid of the environmental regulations which are designed to keep all of this stuff down. He's getting rid of all of that. Like, if the reports are true that he's going to deploy the Doge AI to go through the code of federal regulations and just get rid of all of the redundant crap, all literally like, like it's like all the, we in our DNA, we have all this old legacy DNA that's not active, but it's all there from, previous, evolution. We have all that stuff that could be stripped out of the genome. Like the code of federal regulations looks like that on steroids. So let's get rid of all that. That gets rid of, it gets rid of all the jobs that are being supported, government jobs that are being supported by enforcing all of these unnecessary regulations. And let's change the model at the EPA and all the rest of it. Let's get people working again. So I see copper going higher. Silver clearly is undervalued. Gold on all the monetary issue, the monetary issuance that's coming in the confidence in the current sovereign bond system. Now, gold is going to do a lot of interesting things along the way as it gets to $5,000 an ounce, which is my short-term, medium-term target on gold. I honestly think that gold at $5,000 an ounce makes current gold reserves in the United States. It means that the Fed is only about 4-to-1, 5-to-1 leveraged. This isn't bad. 20% of gold, 20%. It winds up being 20% of the Fed's balance sheet. And if the Fed cuts interest rates, the Fed could also restart QT and shrink the balance sheet further. Once Fannie and Freddie are out of conservatorship and they're moving again, and there's an actual honest market in mortgage-backed securities, which we don't have currently, and that's a different rant for a different day. That's going to change that as well. It's going to make a lot of those legacy mortgage-backed securities capable of being rolled off the Fed's balance sheet and sold off that way as well. So, but that's one part of it. So, and then base metals across the board, aluminum, iron, steel, lead, they're all going to go up. And if you look at their price charts, what you've seen is a massive pump and dump in, trader speak, going back to COVID. COVID destroyed all the supply chains, shut everything down. Prices of commodities soared. And you watch, and across the board, I don't care if we're talking softs, we're talking grains, we're talking lumber, we're talking copper, we're talking, everything. They all did the same thing. Generally speaking, the pattern all looks the same. They were trading at or below what used to be the upper limit of their price band. So, for example, copper at $4 a pound, oats at $3 a bushel. Stuff I used to look at all the time. Aluminum at $1 a pound, or $2.20 a kilo, right? Or 95 cents to $1 a pound. And they all went way up there. Nickel went crazy, right? They all went wee, and then they all came back down again and crashed. They went up by a bunch, and then they crashed by 90%. Kind of Bitcoin-esque, actually. But what happened? They all settled at or above the old ceiling price. The old ceiling price is now the new floor. So $4 a pound, that's the floor now on copper. Okay. Go across the board on all of these things. The only things that have violated those numbers, and I'm surprised about this actually, but in the end, not really, because oil prices are so low, are like corn and wheat prices. They're really in the gutter on an inflationary adjusted basis, but I think that's, also part of the desire to destroy those markets. Like, there's a whole, we live under such an aggressively anti-human agenda at every level that we have to unfortunately be a little Fox Mulder about everything, from the X-Files. We have to just assume first that somebody's trying to, starve us to death, and then check that heuristic to see if you're right. And then if not, oh no, it's just this thing that happened. Okay, fine, great, but I was wrong about it. Whatever. But you got to at least assume first they're lying or trying to starve you or trying to rob you of your democracy or your agency in some way. And then if you just no, it's just the market. blah, blah, blah. But then it never really works out that way. Every time you dig in really far on any of these things, it always turns out that there's some dickhead from the city of London or from Europe or from Wall Street or whatever that like manipulated the market into this condition. And, like it's always something like that if you dig hard enough. And that's why it's so obvious after a while. But that being said, energy prices are too low, ultimately, in order to affect rational capex, to do the things that need to be done in order to build any of this stuff out. One of the things that really bothered me during the Biden administration was, they were selling off the oil from the SPR to suppress the price, the strategic petroleum reserve to suppress the price. And that was the big story. What you noticed at the same time was that the volatility in price of oil, the price of a barrel of oil, doubled on a weekly basis. So, every week when I do my private podcast for my patrons, I have a whole chart section. I go over gold, silver, Bitcoin, Brent crude. And one of my longstanding rants is that I watched them raise the volatility on oil to the roof, where oil as a percentage on a weekly basis, the range low to high, as a percentage, I can chart things on a weekly basis, went from about 3% of price to 7% of price. Now, to give you some perspective, gold is about 1.4%. And gold, according to the BIS and Basel III, is too volatile an asset to be used as, bank reserves at 1.4%. Silver is about 4%. And oil is now 7%. Now, in a world that runs on oil, whose entire investment profile is based on being able to count on the oil futures oil futures curve to align production and consumption, for producers to do capex and exploration, and for consumers to set prices in the future to buy, so that we can have a nice, orderly economy. How are you supposed to do that when the price of oil, the underlying asset for the entire global economy, shifts 7% a week, low to high? How are you supposed to do that?
And what would be the factors that influence that? Would it be the traders? Would it be the ban, let's say, on Russia and things like that?
No. It's the fact that the Brent crude contract doesn't deliver oil. It's a purely financial contract. Just like the lumber futures contract, which now everybody is using to tell us that housing in America is collapsing because the lumber futures of like lumber futures isn't a real contract. It's not. It's a spec. It might as well be a CFD at some cheap Cypriot, Forex trading site, for Christ's sake, because that's what it is. No one delivers a barrel of oil based on the Brent crude contract. They price their lots of oil that they buy based on the price of Brent crude, but they don't actually deliver it. No one is going to show up at the end of the month when the contract rolls over with the 1,000 barrels of oil that that you're long represented. Like, you go to the CME and you enter into a contract with soybeans and you don't close your long position. They're calling you in 3 days to take delivery of 1,000 bushels of freaking soybeans. And if you're some dude, day trading in Dubuque, I got news for you. They're calling you for a delivery schedule to dump it in your front yard. No one's doing that with Brent crude. Again, this is another one of those things that we take it all for granted, that it's like it's supposed to work this way. Because we're all taught, well, this is what commodity futures are about, and this is how it works, blah, blah, blah. But it doesn't actually work that way. And we know this. This is why the Shanghai gold contract was so very important when it came out, because it's a fully physically settled contract. There is no settlement possible in currency. on the Shanghai gold contract and the Shanghai silver contract, which is why when you look at this futures price today, again, Vince Lonsky and I did a great podcast on this ages ago when we first started seeing this happen, which is the following, which is you look at the gold price today, I chart the cash price of gold, the spot price, because of the data set that I use. It's a cleaner price. But it's consistently now $60 to $75 less than the futures price. Gold's trading at $3,600 this morning. Cash prices, I don't know, 35.30, 35.40. Why is that? That's because the gold is shifting from left to right, from east to west, or from west to east. There's such massive demand to physically settle the Shanghai contract that people are willing to pay whatever they can on the futures contract to secure future supply. Meanwhile, the spot contract, the spot price is trading at a lower price than that because the futures price is frothy, right? That arbitrage that refuses to close, there's a natural arbitrage there that should close immediately. And it can't close. Why? Because there's not enough physical gold to close the arbitrage. Now imagine what the price of oil would be if the Brent crude contract actually delivered Brent crude. Think it'd still be $67 a barrel? You think it would every day you wake up and I wake up and I'm like, what's the price of oil today? I don't know. It was $68 yesterday. It could be anything today. And I wake up on some mornings and it's down $3 on nothing. Like, you can't plan an economy on that. So, okay, what's the point of the rant? Well, the point of the rant is that that's not a bug of a dying system. That's a feature of a system designed to destroy human innovation and to hold us in amber economically because we can't rationally plan for the future.
Okay.
That's the point. And it's all tied in with climate change and this and AI and all of this lunatic nonsense coming out of the usual suspects, the City of London, Brussels, and all the rest of it. The Chinese aren't involved in this. The Russians aren't involved in it. The Americans don't want it. It's the same group of evil freaking technocrats who are now braying for more war in Ukraine to extend this thing into perpetuity. It's so obvious at this point.
So I like to put everything that's happening into individualistic perspective, so that what can a person do about all this? So this is why my next question would be more on the portfolio structure in the current environment. So we already touched on gold, silver, commodities, but would you use anything else to make portfolio more balanced and versatile, just so that it's ready for everything that can happen?
This is the thing. Yeah, I mean, from a portfolio perspective, I've had a very simple argument for a long time. I break it down by gold, goats, and guns, to be honest with you. Gold, which is your income producing, your dividend streams and your high income producers in order to generate cash flow. So gold being a proxy for cash and savings, it's a means by which an investor can produce savings and then he can then deploy them. Goats being a proxy for industry, meaning that's where you go into your big producers and you say to yourself, okay, I like these sectors, I like this stuff. And then guns are your defenses, right? They're your hedges against your primary thesis, right? So if you have an anti-dollar, or you've got, for example, if you have a pro-dollar strategy, what would you put in there? Where you put Bitcoin in that as a hedge. So or you put commodity, you put a commodity ETF that is trading financial products in order to try and generate some revenue there. So you're trying to something to offset those things. In the producer category, I mean, look, I'm a commodities, resource guy. Ultimately, I have some stuff in our portfolio, a little outside of that stuff, but there are opportunities everywhere. What I would say right now is, let's go back to the discussion about credit-based assets versus commodity-based assets or innovation-based assets, right? You can broaden that you can broaden that to where capital has been concentrated and people have made a lot of money on because number go up. And that's, supported by this idea that if you strip the Mag 7 out of the S&P 500 and you look at the S&P 493, it hasn't moved, meaning all the rise in the S&P 500 is the result of the rise in price of the Mag 7, NVIDIA, Apple, blah, 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 blah. What does that tell you? It tells you that we have an overinvestment in a lot of those stocks. And that when the rotation happens out of those stocks, when they finally hit their peak, because that narrative can't play itself out any further, because NVIDIA has no one else to sell freaking chips to, because they've already sold them all, because they have 90% market share. And when you have 90% market share, all you can do is go down. If you're not sure about that one, ask Intel in 2013 when they had 70% gross margins and owned 95% of the data servers, the desktops, and the laptop industry in the United States, and honestly globally. But if that were the case, why at that time, why was Brian Krasnich one of the worst CEOs in history? Oh, by the way, why was he out there having to use his profits to marketing budget to stop his competitors from making inroads? Why? Because he had to protect those 70% gross margins because his product wasn't any good, because the up-and-comers behind him, meaning AMD at the time, they couldn't allow them to make any inroads into any market anywhere. The early version of the Ryzen chips. Well, what destroyed Intel, of course, was the rise of all the mobile chips and Apple, just outperforming all of them. Okay. So, but Intel had nowhere else to go but down in 2013. Nowhere else to go but down. And now look at where they are today. So, from an investment perspective, look for areas like that. If you want to know where to put in what I would call the GOATs portion of the portfolio, look for that. In the gold portion of the portfolio, it's easy. Go look for a sector that's beaten down because of high interest rates, knowing full well that Powell just changed monetary policy. Now, I'm not going to tell you exactly what that is because, dude, that's my business. Like selling the newsletters. I mean, everybody's talking their book a little bit. I'm not going to tell you where I'm going to put my money. But look at areas of the market that have been beaten down because of high interest rates and because of the current Fed policy. Understand that policy is going to change. That Powell will likely cut rates by 100 basis points before the end of the year, if not 100 a quarter. I'm betting on 50 next week, and then 2020, 25 and 25. Same pattern as last year. 50, 25, 25. That's what I think he's going to do. And then he's going to exit the scene. Maybe even leave a little bit early if Congress can come up with a suitable replacement for him that works for Trump. Once you understand the scenario, there's plenty of good assets out there that are paying, income streams above their normal run rate, right? And if they're paying income streams above their normal run rate, I don't care if it's, I don't care what it is. REITs generally pay about 3.5%. You find a REIT that's paying 6% with good coverage ratio. Maybe you're in good shape, right? Maybe that's an opportunity. So I wouldn't be, would I be long French muni bonds? No. You know what I mean? And then the producer portion of the portfolio, you got to ask yourself, well, where's the underlying asset? I mean, dude, at this point, you can see the disconnect between oil majors all trading near their 5-year highs and oil being at $67 a barrel. Imagine what happens if oil just pops to $78 a barrel, where their charts are going, because everybody's underinvested in oil, and that's obvious. And so, I mean, I don't know. I mean, there's a lot of good opportunities there, but the big one for me is that we've concentrated too much capital in certain stocks, which then become its own form of strategic weakness. because it's a pressure point. Because who owns those stocks? Who's going to sell those stocks? A lot of that, maybe in American 401ks and and whatnot. But some of that is not. Some of that is owned by nefarious actors who are going to dump those things on the market. Everybody's talking about they'll dump treasury bonds and they'll send our yields higher. I'm like, that's nice. Our banks are starving for freaking tier one capital, folks. We'll just suck that shit up like it's candy. Oh, I'm sorry. I won't invoke my friend Brent Johnson and the dollar milkshake theory. No, I'm thinking more about, they'll dump NVIDIA and start a run on the stock market, right? They'll sort of run on the VIX and then sort of run on NVIDIA. They tried this in April with this attacking the SOFR strip during the tariff tantrum, and it failed miserably. It failed miserably. Now we have the Dow at all-time highs. This is all a long way of saying what Trump is putting in place. When you think about what I said at the beginning of the podcast, what Trump is putting in place is a system that is going to benefit Main Street more than Wall Street. Okay. And it's going to benefit Main Street in a fundamentally different way than we've seen in all the years that we've all been alive. I'm 57 years old. I've never seen anything. I've never seen this. I've only dreamed that somebody would actually consider even doing this, and that maybe they'll get there before I die. No, he's doing it in like a year and a half, which is phenomenal. Don't get me wrong. What does that mean? Well, if you've got all this capital in 7 big stocks, 6 of which are shit, and 1 of which is good, Apple. Apple's still fundamentally undervalued, for Christ's sake. It's insane, right? The other 6 are garbage. There's going to be a rotation out of that, but where's it going to go? Is it going to go to oil majors? Is it going to go to $200 billion mid caps? No, it's going to go to the Russell 2000. It's going to go to the small, medium startups. What Trump is setting up is the return of entrepreneurship. The regulatory scheme that's been put in place, all that talk about Doge going through the CFR. What do you think that's about? It's about getting rid of these, getting out of the way of people being able to start businesses and grow them, and opening up their cash flow. You have to open up Main Street's cash flow on a monthly basis in order to affect a real durable American renaissance. And this is the same, and this is not just America. That model needs to be exported to all of Europe and Australia and everywhere else.